A very good evening to all of you students. Good evening, Kiran, Sudhanshu, Bhumika, Darshan, Syed, Hira. Good evening, everyone. So let us resume from where we actually left. So in our previous sessions, we have completed till question number 14, right? So what we are going to do is we are going to complete our practice questions first today. Then we will quickly revise both risk analysis in capital budgeting as well as the dividend decisions from the conceptual point of view as well. Good evening, Manisha. Good evening, Rajiv Kumar. Okay. I hope all of you would have done at least one round of revision post our previous session. So let's start. Question number 15. M Limited belongs to a risk class for which the capitalization rate is 10%. So let's keep on noting down the information that is given in the question. Cost of equity is given as 10%. So we said that capitalization rate, cost of equity, all is same. It has 25,000 outstanding shares. So the number of shares currently are 25,000. Current market price, which is P0, is 100. It expects a net profit of 2,50,000 for the year. So earnings are expected as 2,50,000 for the year. And the board is considering a dividend payment of rupees 5 per share. Since board is considering, hence I'm assuming that it is going to be D1. So it is going to be paid within the next year, okay? Yes, good evening, Suraj, T. Hari Prasant, Aisha, Krishna Bagoria. Good evening, everyone. M Limited requires to raise 5 lakh for an approved investment expenditure. So investment, how much are they saying that they are going to do is around 5 lakh rupees. Illustrate how the approach, is Modi, Gilani and Miller approach, affects the value of M Limited if dividends are paid or not paid. That is what I think we have studied in approach. So the value always remains same. It is not at all changing basis the decision whether you are paying dividend or you are not paying any dividend. Correct. So with this question, I think we will be able to again see what was being taught under the approach. So case A, I am assuming dividends are paid. Dividends are paid. So once let's say you say that dividends are paid in this particular case, first of all, we will try to calculate this. There were 4 steps, right? Step 1, calculation of the price. Step 2, calculation of the funds requirement. Step 3, calculation of the new equity shares to be issued for those fund requirement. And step number 4 was simply calculating the value of the firm. Okay. So P1 was, P1 is equal to P0, 1 plus KE minus D1. This was our formula. So we can arrive at P1. P0 was 100, 1 plus 10% minus 5. Since this case we are saying dividends are paid, so we are reducing minus 5 from here. So P1 comes as 105. Then the next step was, this is A case, first part. Second step would be to calculate the funds requirement. How are we calculating the funds requirement? Simple. Let us first of all see what all things the company already have, what all, such as they are already having a decision to make an investment. Secondly, they are also having a decision to pay some dividend, correct? So let's use that. Investment would be how much? 5 lakh rupees, of which they are already earning an amount of 2,50,000. Hence, they will be able to self-fund 2,50,000 from here. Then there is a payment of dividend as well on 25,000 shares multiplied by 5. So that comes 1,25,000 rupees as the dividend amount. So net funds required. Net funds required is 3,75,000, for which they can issue the new equity shares in the market, because that's what we studied in Modi, Gilani and Miller approach. They say that whatever is the fund requirement, the company has to issue new equity shares. So the number of equity shares to be issued will be how much? 3,75,000 divided by 105. Okay. So again, I'm not calculating this because we can use this in our formula. Then the last step is calculation of value of the firm. How can we calculate that? Value of the company or value of the firm is existing share, new shares multiplied by P1 minus investment plus earnings whole divided by 1 plus KE. Correct? This was the formula that we studied in our previous session. So this brings us to N is 25,000 plus 3,75,000 divided by 105 multiplied by P1, which is 105 minus 5 lakh was our investment plus 2,50,000 is what we have earned whole divided by 1 plus 10%. So if we solve this, then the value of the company, or let's say the value of the firm, if dividends are paid, is 25 lakh rupees. So this is the very first case under the approach. Then let's take the second case. Dividends are not paid. Step 1, price at the end of year. P1 is equal to 100, 1 plus 10% minus 0. In this case, it will be 0 because we are assuming in this case the dividends are not paid. So P1 becomes 110. Then second part, the second step, funds requirement. Funds requirement is 5 lakh minus 2,50,000. Net, they need a fund of 2,50,000. I'm just skipping the proper presentation here, correct? Because the proper presentation can be looked from the previous part. Then number of new shares. 2,50,000 divided by 110. Then ultimately value of the company will be 25,000 plus 2,50,000 divided by 110 multiplied by 110 minus 5 lakh rupees for investment plus 2,50,000 for the earnings whole divided by 1 plus KE. Sorry, which is 10%. So if you solve this as well, the value of company will be 25 lakh rupees. I hope this is clear, students. So in both the cases, value of the firm remains unaffected, whether we pay dividend or whether we don't pay dividend, which is the essence of entire approach. Correct? Let's come to question number 16. The following information is supplied to you. Total earnings is given as 2 lakh. Number of equity shares of rupees 100 each as 20,000. Dividend paid is 1,50,000 and PE ratio is 12.5. Apply Walter's model And they're asking us to analyze whether the company is following an optimal dividend policy or not. Now, students, yeah, thank you, Bhumika. Let's go step by step in this question. Let's try to first understand. For determining whether company is following an optimal policy or not, what two things you need? There are two things that you need, right? One is R and one is KE. R is the internal rate of return, or let's say the rate of return on the investment that is being done by the company, and K is the cost of equity, or let's say cost of the capitalization rate, or whatever the market expectation is. Correct? Now, for calculating R and KE, R is actually what? R is the rate of return generated by the company themselves. Okay, Suraj, I will check whether we can share the handwritten notes or not. If it is possible, I will definitely share it. Yeah, Darshan, thank you. So what I'm saying is R is actually the earnings per share divided by book value per share. Can I say this? Yes. And we have already seen that reverse of P ratio is equal to KE. Correct? So R is the internal rate of return, which we can easily derive. Let's say whatever is the earnings that per share we are doing divided by the book value per share. And similarly for KE, 1 divided by PE ratio will give us the amount, the percentage. So let's try to calculate EPS first. For calculating our EPS is, see, we are taking a total earnings of 2 lakh, out of which the entire is attributable to equity shareholders because nothing is given in terms of the preference shares. And the number of equity shares is 20,000. So 2 lakh divided by 20,000 becomes our EPS. And what is the book value per share? The book value per share is also given as 100. Correct? Because here they have clearly mentioned the share, the per share price, or let's say the per share value is 100. Sorry. So this brings 2 lakh divided by 20,000 is 10. 10 divided by 100 gives it as 10%. Okay. Then coming on to the KE part, which is 1 divided by P ratio. P ratio is already given as P ratio is already given as 12.5. Hence K become 8%. Okay. So now we have R as 10% and KE as 8%. Can we analyze now whether company is following an optimal dividend policy? Yes, because we have all the inputs now with us. So if we see only this data, the company is able to generate a return at the rate of 10%, which is higher than the expectation from the market at the rate of 8%. Correct? Because market would say that 8% is what I'm expecting. On the other hand, company is able to generate a return of 10%. So optimal dividend policy would be to reinvest all the earnings back into the business. And 0% payout, correct? Because ultimately the wealth maximization happens if the expected amount of 8% is invested in the actual return of 10%, correct? Now, what is being followed by the company? Company is actually paying dividend of 1,50,000 out of the 2 lakh earnings. So the company is not following optimal dividend policy. Okay. Compute the P ratio at which the dividend policy will have no effect on the value of the share. Now they're asking us to compute the P ratio at which the dividend policy will have no effect. What is that ratio? Whenever R is equal to KE, whatever dividend you pay, whether you pay 0 dividend or whether you pay 100% of your earnings as dividend, the P ratio is not going to have any impact on the dividend policy. Okay, so basically they're asking us to analyze. So let's do one thing. In the first part itself, let's try to prove this also. Let's take 75% payout, which is currently happening, and 0% payout, because this is what we are suggesting, correct? So this is suggestion, and this is actually given in the question, correct? So basis 75% payout, we will have to calculate the value as per the Walters model, correct? Because they're asking us to apply the Walters model. Now, as per Walters model, price will be equal to dividend plus earnings minus dividend into R divided by KE whole divided by KE. This is what the formula is. Now, here we can calculate dividend. Calculation of dividend per share. So, dividend we are paying how much? Around 1,50,000 divided by number of shares, which is 20,000. So 7.5 per share dividend is this much, correct? Let's put it here. Price is equal to 7.5 plus earnings per share was how much? We have calculated above. Earnings per share is 10 rupees. 10 minus 7.5 multiplied by R is how much? 10% divided by K is 8%, whole divided by 8%. And in this case, 0% payout case, let's calculate the P, which is 0 plus entire earnings 10 minus 0 into 10% divided by 8%, whole divided by 8%. That's what we will do. So here the amount, or let's say the value per share that comes is 132.81, and here it comes as 156.25, which is eventually lesser than what we are suggesting. So if we would have followed the optimal, policy, our share price would have been higher. That is what we are trying to say. Okay. So Bhumika is saying, since R is greater than K, therefore company is not following optimal dividend policy. Very good, Bhumika. Yes. Karthik. So Karthik, this part we need to clarify. I'm not sure whether tomorrow some other class would happen or if there is a change in schedule. So if there is some portal at which the schedule is populated, please do check there for the tomorrow session. Krishna. Okay, I will show the above. I hope you would be saying this. Okay. Then the next step was this, where we proved our suggestion was right, which is the 0% payout as per the Walters model. Okay, and this is what we have concluded till here. Then what we said next, what is the question? Second part of the question, compute the P ratio at which the dividend policy will have no effect on the value of the share. Can we simply compute it? Yes. The idea here is when R is equal to KE, then any dividend policy, any ratio of dividend payment is an optimum ratio. In such a case, we will say that R is equal to K is equal to 10%, and P ratio we already know that it is 1 divided by K. If K is reverse of P, P is also reverse of K, right? Both the things hold true. So the P ratio comes as 10 times. 1 divided by 10%, it comes as 10 times. So once P ratio becomes 10 times, the optimal dividend policy will be any ratio, because then it will be equal to R. Okay, sorry, Krishna was asking the below part. Okay. Okay, Krishna, I will put it here again. I will wait for a moment. Okay. Darshan is asking, sir, in the formula, variable D is dividend per share or dividend payout ratio. No, variable D is dividend per share, Krishna. Sorry, Darshan. Darshan is asking in the formula whether variable D is dividend. Yes, D is dividend, not dividend payout. Okay, Kiran is saying there is no class tomorrow evening. Okay, maybe as per the schedule, I don't have access to that. So if Kiran is saying that there is no class, so I would request everyone to check and plan accordingly. Okay, thank you, Kiran. I think Krishna also said okay. So we were here. Okay, so we have computed the P. Then comes the third part of the question. Will your decision change if the P ratio is 8 instead of 12.5? Yes, our decision might change because they're asking the decision from the first part's angle, which is whether the company is following an optimal dividend policy or not. So let's, okay. Sorry. Just a second. Huh? Yeah. So third part of the question was, third part of the question is, if the P ratio is 8, then KE would become 1 by 8, which is actually 12.5%. Now, if we compare KE as 12.5 and R, which is actually 10%, then KE greater than R. In case KE is greater than R, optimal dividend policy will be dividend would be 100% payout. Correct? So let's first calculate in the case A basis the current dividend payment, or let's say current dividend declared. So basis that the price as per Walter's model will be, because the question is asking us to calculate the price as per Walter's model, right? So 7.5 plus 10 minus 7.5 multiplied by 10% divided by 12.5%. Please note this change, and whole divided by 12.5%. So the price becomes 76. Okay. And in case of 100% payment, so B, 100% dividend payout, price will be 10 plus 10 minus 10, 10% divided by 12.5%, whole divided by 12.5%. So ultimately 10 divided by 12.5%, correct? So this becomes how much? 10 divided by 12.5, which is 80 rupees. So the price in this case becomes 80, which is again higher than what it is coming as per the current payment, right? I hope this is understood. I'll just project this for a moment so that all of you can see. Yes, Bhumika, 80, you are right. Okay, thank you. Let's come to question number 17. With the help of the following figures, calculate the market price of a share of company by using Walter's formula and Gordon's dividend growth model, which is the Gordon's revised model, right? EPS they have given, DPS they have given, cost of capital, R, which is internal rate of return on investment, and the retention ratio. Anyway, the retention ratio was not required. We could have also calculated this by 6 by 10, but they have given. So first, so this is just a revisionary, question, right? Nothing big in this. Using Walter's model, or let's say formula, price is equal to dividend plus earnings minus dividend into R divided by KE whole divided by KE. So the price will be 6 plus 10 minus 6 multiplied by R is how much? R is 25%. Cost of equity is 20%. Whole divided by 20%, which gives us the value of 55 per share. So the price is equal to 55 per share. Second part. Second part, they're asking us to use the dividends growth model. Okay. So as per dividend growth model, price is equal to earnings 1 minus B divided by KE minus BR. Or we also said that if you don't want to use this, or let's say some other information is there, so D0 1 plus growth divided by KE minus G, where the growth is given and the current dividend payout is also given. So the price will be 10, 1 minus 0.40 divided by what is KE? KE is 20% minus B into R. Retention ratio is 0.40 multiplied by 0.25. So the price as per this formula comes as 60 per share. Okay, Varsha is saying part 1, please. I will show this part first. Okay, so this is, I think, easy. Then this is part 2. Part 2, students, what I'm doing is I am actually removing this formula so that it might create a confusion. Okay. Basis whatever is given in the question. We can apply this formula. Okay, so Darshan is asking in this May 2023 attempt, 2 compulsory questions from these 2 chapters, each of 5 marks came. Hope we will get the same thing like that. That no one can say, Darshan, that no one can guarantee how much will come from where. Okay, so we will have to be prepared for worse. That's why it's better to give your best shot in all the topics. So I might not be able to tell you whether, what will come from which chapter. Okay. Shall we move, or all of you writing? Okay, let's go ahead. Question number 18, students. The annual report of XYZ Limited provides the following information for financial year 2021. Net profit they have given, preference shares they have given, number of equity shares also they have given, return on investment and KE. R and KE, both of the things they have given. Calculate the price per share using Gordon's model. When dividend payout is, they have given different dividends payout. I think this is very easy question. So I'm skipping this. All of you can actually try this as per the practice. So this is very easy because all the things are given. We have to just apply the Gordon's models and come to a conclusion. So let's come to the next question. I hope this is okay. So Kiran is saying how to master it with accuracy. Kiran, see, I mean, it's very simple. Just be sincere in what you do. First of all, whatever is being taught at the first instance, so try to absorb it, try to understand it from all the angles. Then the revisions are must, correct? Because ultimately what happens for the CA examination, understanding is one, but taking it to the examination hall also matters, correct? So what you will have to do is you will have to revise. Until you revise, the things won't get, fed into your mind so that it can come onto the examination sheet. Ultimately, that is what our objective is, correct? So revision is must, I would say. At least 2 to 3 times we need to revise before we are preparing, and preparation while we are on leave, or let's say while we are preparing specifically for exams. So at least 2 to 3 times revision there also is needed. Okay, now the smart revision also you can do. So let's say whatever special notes, or let's say the notes you are making, so go through all of those notes. But while doing the questions, now if you see the total 18 questions we have done, some of them are repetitive, some of them have unique things. So whatever unique things you find, whatever unique things you are getting, so keep a special mark on it so that in the next revision, you don't forget to take a revision on that unique thing. For example, we studied that K is reverse of P ratio because that is in some of the questions that is used, right? So whatever things are unique to your understanding, please do mark them and take a revision in the next part. Okay. Time is limited. Yes. So Kiran is saying not able to complete it in time. Time is limited with everyone, right? It's not there with only one person. So see, time is limited with all the students who are appearing in C examination. So we will have to actually see that, I mean, what are your good learning areas and what are your learning areas where you need to devote more time. So that is how you can plan. Correct. Anyways, let's come back to the question number 19. Yes. So this is one of the good question, right? I mean, this is something what different from what we have till now solved. So let's start reading this. A&R Limited is a large multi-cap company listed in Bombay Stock Exchange in India with a face value of rupees 100 per share. So they're saying A&R Limited is a very large multi-cap company limited listed, which is listed on a Bombay Stock Exchange, and they have a face value of 100 per share. The company is expected to grow at the rate 15% per annum for the next 4 years. Okay. So can we make, let's say, a chart? So for next 4 years, they are saying it will grow by 15% and 5% for an indefinite period. After that, it will grow if it will keep on growing 555%. So this is, let's say, year 1. This will be year 2, 3, and 4. So here to here, it will grow by, let's say, 15%. Then year 1 to year 2 again, it will grow by another 15%. Here another 15%. And here another 15%. And ultimately, then it will keep on growing by 5%. Correct? Year on year. Now, let us read it further. The shareholders expect 20% return. The cost of equity is 20%, which is simple, right? As we discussed, whatever their shareholders expect becomes the cost of equity. Okay. Company paid rupees 120 as dividend per share for the financial year 2021. The shares of the company traded at an average price of 3122 on last day. So they have given the market price as 3122, and they have also given us the current dividend, which is 120. Correct? Find out the intrinsic value per share and state whether the shares are overpriced or underpriced. So they are asking us to do the share valuation first, and then compare that share valuation with 3122 to say that whether so basically don't get confused with the word here, intrinsic value. Intrinsic value is basis whatever is the internal value of the company on the basis of data that is given in the question. So that intrinsic value, we have to compare it with this market value and see whether the shares are overpriced or underpriced. Okay. So students, this is just a different way of presenting the dividend discount model, correct? Because they have given us the base dividend to start with, and they're asking us to calculate the price on day 1 and compare that price with 3122. So let's say 120 is here. How much here dividend will be? 120 into 1.15, which is the growth rate, correct? So now please pay attention here. 120 into 1 plus 15%. This is the dividend that will be there in year 1. And to take a present value of this, we will do 1 plus 20% plus 120 multiplied by, I should not put brackets, otherwise all of you will get confused. Yes. 120 multiplied by 1.15 multiplied by 1.15. This is for year 2. 1 plus 20% raised to the power 2. So this is year 1. This is year 2. So we are taking the present value of all the dividends that are expected to come in future. That is what we have discussed in the dividend discount model. Then similarly, year 3, it will be how much? 120 into 1.15 into 1.15 into 1.15. This is 3 times divided by 1 plus 20% raised to the power 3. Okay. Then year 4, 120 into 1.15 raised to the power 3. Sorry, 4 this time. I'm just putting a raised to the power 4. One plus 20% raised to the power 4. So this is for year 3 and this is for year 4. Then comes the terminal value, because in your capital budgeting knowledge, you would have already understood how this terminal value is computed, correct? Because if something is expected to grow by 5% perpetually, in your capital budgeting also, what you used to do, you used to take that terminal value and then take a present value of that. So first of all, let's calculate what is the terminal value. The terminal value will be 120 into 1.15 raised to the power 4. You will reach the value that will be appearing on year 4. In that, you will multiply the growth, which is 5% again. Correct? Because from year 4 to year 5, it will grow by 5%. And this we used to divide by the discount rate minus growth rate. Here, the discount rate is the capitalization rate or the cost of equity, which is 20% minus 5% multiplied by 1 divided by. So this value, so this becomes the terminal value at 5th year end. So this we will have to divide by 20% raised to the power 5. So this is the present value factor from 5th year to 0 year. Correct? So if we do this plus plus, I mean, I'm just removing the things that I put so that for the explanation purposes, whatever I'm putting here, I'm just removing it so that we can just simply put the value. Okay. This one too. I just put it to explain. Okay. So if we total the calculations, it becomes 1022.42. This is very similar to some kind of a capital budgeting present value, right? For the present value of your cash inflows, the way you do a capital budgeting, because in that case, in the last year, there is some perpetual growth that is coming. So you will have to account for that and accordingly solve the question. I hope this is clear. Now, what they're again asking us is, what they are again asking us here is the comparison between intrinsic value. So this, what we have calculated is the intrinsic value. Okay, students. This is actually the intrinsic value. So actually, if you see, now there is a question. Okay, Kiran is asking what is intrinsic value. Let me first take that. So if you see, intrinsic value has to be always understood in the context of the question. If you ask me, intrinsic value in general is the book value per share. Okay, whatever is your book value per share, that is your intrinsic value. But in this particular case, since the question has not given us anything to calculate book value per share, so they're trying to refer the intrinsic value as basis whatever inputs that they have given, which is on the dividend discount basis. So whatever the calculated value is coming, that they're referring as intrinsic value. Now, basis whatever is given in the question, definitely it will have an implication that we can only apply the dividend discount model here, because they have given us the current year dividend, they have given the future growths, and they've given a terminal growth also. Correct? So I hope that intrinsic value discussion is clear. Now Darshan is asking, can you explain the numerator and denominator in calculating the terminal value once? Okay, I will explain it. So if you see, so let me put it through a red pen so that it can be clearly demarcated. So till here, 120 into 1.15 raised to the power 4 actually gives us the future value, or let's say the dividend value, I would say, at the end of fourth year, right? At the end of fourth year, what is the value? Now, this we are multiplying by the growth that is expected in the fifth year to make the entire numerator as year 5 value, correct? But I think you would have already studied in your capital budgeting, when there is a terminal value calculation needed, you will not divide simply by 20%. You will actually reduce the growth by which it will be offsetted, because 20% is the discount factor, the present value discount factor, but there is a 5% growth also happening. So that is why we have reduced 5% from here. And then ultimately this value, whatever it comes, it comes as the future value at the end of fifth year. And to take it to the present value, we have multiplied by the present value factor of 1 by 1 plus 20% to arrive at this amount. Okay. Now let us do the comparison. The comparison is share price 3122 is higher than intrinsic value of 1022.42. So ultimately this denotes that the shares are overpriced in the market. Correct? Because shares have a price that is higher than the calculation that it is throwing. Okay, students? I hope this is clear. Yeah, let's move forward. Okay, I'll wait for a moment so that all of you can absorb this and take your time to note this down. Let's come to question number 20. Again, a very, very good question. In May 2020, shares of RT Limited was sold for 14,060 per share. That is the price per share that they have given. A long-term earnings growth rate of 7.5% is anticipated. So the growth rate, long-term one, they are anticipating as 7.5%. RT Limited is expected to pay a dividend of 20 per share. That is also they have given. All of them is what they're expecting, right? A growth rate is anticipated. Dividend is also expected to be paid at 20 rupees per share. Calculate the rate of return an investor can expect to earn, assuming that dividends are expected to grow along with the earnings at 7.5% per year in perpetuity. So now students, if you see what they are saying, the earnings will grow by 7.5%. Now what we can actually infer from here, earnings would grow 7.5%. And they are saying that dividends are also expected to grow along with the earnings. Dividends, sorry. Are also expected to grow by 7.5%. So this fact is clear, correct? Now, since the question here is on dividend, correct, and they have also given us the price, don't you think they are asking us to calculate what? they're asking us to calculate the rate of return, which is KE. Correct? Because the rate of return an investor would expect is KE, correct? So we can actually use Gordon's model because the question is itself directed that the dividend will grow. Okay, Krishna is saying last line. Sorry, students, let me just go and finish this. This is what I have written, Krishna. This is overpriced in the market, okay? So coming back here, since the question has already indicated that it is a case of dividend growth, so we are using the dividend growth formula given by Gordon. Because obviously it has price, it has KE also, it has growth also. And these are the 2-3 things that are given in the question. And it has dividend also, right? Because they have given us dividend. So we know that as per dividend growth formula, P0 is equal to D0, 1 plus growth whole divided by KE minus growth. Correct? And we also know that actually D0, 1 plus growth is equal to D1, correct? Because whatever growth happens in D0, that is ultimately D1. So we can substitute this as D1 divided by KE minus growth rate. Correct? For the simplicity and basis the facts that is given in the question, we have actually substituted the D0 1 plus growth by D1. Now 1460 is equal to 20, 1 plus 7.5% divided by KE minus 7.5%. Now students, please see here, I am assuming one important thing that although the question is mentioned is expected to pay a dividend, but I have assumed that it is D0. Okay. You can equally assume it as D120. That is also fine. Okay, students. But I have assumed it as D0 and hence added the growth rate. So 1460 is equal to, we can actually swap. So KE minus 7.5% is equal to 21 plus 7.5% divided by 1460. So if we solve this, KE comes as 8.97%. Okay, students. So this is what the rate of return that an investor would expect basis the data that is given in the question. Let's move forward. Yeah, there are no queries till now on this. Then the next part, it says that it is expected that RT Limited will earn about 10% on retained earnings and shall retain 60% of earnings. So they are saying that the retention ratio would be 60% and 10% is what their R would be. In this case, state whether there would be any change in the growth rate and cost of equity. Now they're asking us to calculate again whether KE will change or whether growth rate will also change. Okay, so that is what they're trying to ask. So for doing this, first of all, let us take the revised facts. They have told us clearly R is actually 10% and B is what they have told us 60%. They're asking us to calculate the growth rate, correct? That is what they're asking us to calculate. Growth rate, we know, sorry, they're asking us to calculate two things, growth rate and KE. So Darshan is asking, how do we found an appropriate model for this question? Now, Darshan, if you see, what else is given in the question? So there are three models, right? There are three main models that we have studied. One is Modi, Gilani and Miller approach. Definitely it is not. The fact pattern of the question is not saying that, because the company is not evaluating whether they should pay dividend, whether they should not pay dividend, what is the value of the firm. So those all things, and what is the investment, what is the earnings, that is not given as the fact pattern. So clearly M&M approach is ruled out. Walter's model needs both earnings and dividend. Till now, till the first part of the question, there is no question. So there is no fact on the earnings part. So hence Walter's model is also ruled out. Coming to Gordon's model. Now Gordon's model also, there were two formulas, right? One is the earlier one and one is the dividend growth model. So only dividend growth model is suiting the information that is given in the question. So that is how the approach is on identifying the relevant model. Okay. So now let's come back. We know that growth is equal to B into R. Now, B is what? 60% and R is what? 10%. Correct. So we can easily calculate growth 60% into 10%. Okay, students? Which is actually 6%. So the revised growth. Earlier growth was how much? 7.5%. So the revised growth is actually 6%. So the answer to the second part of the question, which says that whether is there a change in the revised growth? Yes, there is a change in the revised growth. Now, if you see, original growth was how much? 7.5%. Now, if R is equal to 10%, that is given, the retention ratio that would have been earlier would be how much? So this is B. So if G is equal to B into R, so B will be G divided by R, which is 7.5 divided by 10, right? Which is actually 7.5 divided by 10, correct? So the retention ratio becomes 75%. The old retention ratio we are saying. So this is the old retention ratio. The dividend per share was how much? Was actually 20 per share. And this is the old retention ratio. Can we find out the earnings? Yes, we can find out. So the dividend ratio we need to first calculate, right? Which is 1 minus 75%, which is 25%. So if retention ratio is 75%, dividend ratio is 25%, correct? So the earnings will be 20 divided by 25%. So which is 80 rupees. So we have back calculated that what would be our earnings. And hence the dividend will be 40% multiplied by 80, which is 32. Why 40%? Because as per the revised retention ratio is 60%, correct? So the revised dividend ratio will be 40. And we can simply use our formula, which is dividend divided by price into 100 plus growth rate. Yes. So this is actually the formula from price is equal to dividend divided by K minus growth rate. Correct. This is the same formula, the dividend discount model from Gordon's model. So if you, and this has been actually reshuffled like this. We can do that. And hence, because we have to calculate KE here, so the KE will be dividend of 32 divided by 1460 multiplied by 100 plus revised growth of 6%. And hence KE will become 8.19%. I hope this is clear. So the bigger issue in this question was to identify that which model suits it, which is actually the dividend discount model from Gordon. And once we know, so whatever inputs are available, we have actually directly taken that, and whatever inputs were not available, that we have tried to calculate to the best possible means that we could have done. Okay, so let's come to the next question. Akash Limited has 10 lakhs equity shares outstanding at the start of the accounting year 2021. The existing market price per share is 150. The expected dividend is rupees 8 per share. So they're saying the existing market price is 150, right? And the expected dividend is 8 per share. The rate of capitalization appropriate, to the risk class to which the company belongs is 10%. So the KE is given as 10%. Calculate the market price per share when the expected dividends are declared, not declared based on approach. So they have given us very conveniently. Thank you, Suraj. So they have told us very conveniently that this is a approach. So there is no second thought. So case A, we will take both the cases simultaneously. Step 1, calculation of market price per share under the Modi-Gilani and Miller approach. A part, dividends are declared. $150, 1 plus 10% minus 8. Correct, because 150 is the current price. This one, 10% is the KE, minus 8 would be the dividend. Okay, students. There is no rocket science in this. I'm just putting down whatever is the formula it is given. B part, dividends are not declared. So the P1 will be 150, 1 plus 10% minus 0. $165, right? So P1 will become 165. Then we have step 2. So funds requirement and number of shares. Let's merge them. And number of shares. A and B, we will take both here. When dividends are declared, here they are not declared. Okay. So how much is the investment required? The investment required. So basically the second step, they're saying calculate the number of shares to be issued by the company at the end of the accounting year on the assumption that the net income is 3 crore and investment budget is 6 crore. So the question is also going step by step. Okay. So we can put it in rupees lakhs here. So 600 lakhs, which is 6 crore in both the cases. Net income is 3 crore, which is 300 lakhs. And dividends. So dividends are required to be paid how much? 8 rupees per share on how many shares? 10 lakh shares. Correct? So 8 into 10 lakh, which is 80 lakhs. And here it is nil. So the net funds required becomes 380 here. And here it is 300. Okay, students. So till now, again, nothing big has happened. It's all what we have studied. Then we will divide it by the price. 157 was here and 165 was here. Number of shares that we are supposed to do the calculation 2.42 and 1.82 lakhs. Okay, these are the number of shares. Then the third part, prove that the market value of the shares at the end of the accounting year will remain unchanged irrespective of whether dividends are declared or not. The only catch here is, students, please read it carefully. They're saying that at the end of the accounting year, okay? Prove that the market value of shares at the end of the accounting year. They are not asking us to calculate the present value, because generally approach gives us the calculation every time at the beginning of the year, right? So that is the catch. And to calculate that, I will explain. Let me first pause for 2 minutes so that all of you can note it down. Then I will go to the third part. Yeah. So the easiest way to calculate, we have the number of shares. We also have the price. Similarly, we have the number of shares, we have the price. So the calculation of value of firm at the end of accounting year. Again, two cases. A, when dividends are declared, are not declared. Correct? Existing shares were how much? 10 lakhs. Delta N, which is the new shares. 2.42 here, 1.82 here. Then lastly, the total number of shares would become how much? 12.42, and here it will become 11.82. Then the market price per share We have also computed 157 and 165, and hence value at the end is actually 1950, and here also it is 1950 approx. The decimals calculation we can ignore. So this is the solution for the third part. And why we have done this? Because, and why we have not calculated using the other formula that is given in the approach is because in that we are trying to calculate the present value. While we reduce investments, add earnings, take n plus delta n, that formula is not needed here because ultimately that will give us the number or the value of the share that is appearing as on now. But the question has specifically asked us to calculate the value at the end, hence we've calculated the value at the end. So we have to be careful on what the question is asking. Till now, any other queries, students? So these were some of the additional practice questions that we just now concluded. Now, towards the, second part of today's session, we will cover 4 questions that are left. And those are from the risk analysis. So these are the practice question 1, 2, 3, 4, with some good things or some good concepts. So once we close on these 4 questions, then we will again do one sort of last revision for both the topics put together. Okay. So it's 7:17 now. Let's break for 10 minutes and let's again reconvene at 7:27. So welcome back, students. Let's start with additional practice questions on both the topics. Okay, sorry, there is one confusion. So this actually is 8-2. It's not 0-2, it's 8-2. It's a typo. Kiran, please note this is 8-2. If you multiply 11.82 with 165, it will be 1950 only, okay? Okay, Bhumika is saying, sir, please explain the last part again. So, okay, for this question, let me again explain what is the last part saying. Now, students, if you see in the normal approach, the last part, we are given one formula, which is n plus delta n, this one, right? N plus delta n, P1 minus I plus E divided by 1 plus KE, right? But this is true if we want to calculate the value as on today. This formula is actually used if we want to calculate the value as on today. But if you want to calculate the value as on the end of the accounting year, which is 1 year from now, then simply you have the number of shares, the total number of shares, which is n plus delta n, and you simply multiply it with P1. That's all. This is what they are asking us to calculate. Okay. Yes. Let's come to the practice question number 1. Let me read out. So, the question is saying A Limited is based out of India and is evaluating a decision to invest in major capex investment either in USA or in Nigeria. So students, please listen to this question very carefully. Okay. Yes. So I'm just trying to pictorially also show. So there are two investment proposals, one in USA and one in Nigeria. Following are the estimates given in the respective currencies. Okay, because if they are trying to invest in USA, the cash flows will be in US dollar. If they are trying to invest in Nigeria, the cash flow will be in Naira, which is their respective currency. The risk-free rate in USA for a 3-year treasury bond is 3%. So they're saying the risk-free rate, the rate in which risk element is not there, that is at 3%. And for any investment made in Nigeria, the estimates from International Monetary Fund implies that an investor would expect 4% as a country risk premium while investing in Nigeria as a country over and above what investor expects from investing in USA. Simple. In the crux of these 3 lines is that if anybody invests in USA, discount the rate is 3%. If anybody wants to invest in Nigeria, so over and above 3%, the investor would also expect 4%. That means essentially 7%. Correct? The internal risk department of the company have indicated as follows. USA estimates are considered to be more certain if 25% of the estimates are stripped out on account of risk uncertainties. Easy till now? So they are saying USA, if you adjust 25%, the estimates will be more certain. Nigeria estimates are considered to be highly risky and hence need 3% further adjustment on expected return of higher risk accounted with the cash flows. So what they're saying is Nigeria, these estimates are highly risky, and whatever discount rate you use, in that you add 3% to account for that riskiness. Yes, Darshan, you are right. 7% is RADR, risk adjust. No, wait. This is not RADR. This 7% is the risk-free investment. In that, if you add this 3%, what the company's internal risk team is saying, that will become RADR. So RADR will be 10% for Nigeria. Okay. Given the exchange rate for USD to INR is this and 1 rupee to Naira is this, which investment should be selected given the same amount of cash outflow? So they are saying you ignore cash outflow, you build the proposal basis your cash inflows only, and you tell us. Now, basis whatever is given in the question, don't you think USA is a case of certainty equivalent approach and Nigeria is a case of RADR approach? Why? Because USA, they have clearly mentioned that you want to strip out the cash flows by 25%. And they have also not given us the RADR rate, the risk rate, right? So Kiran is asking which page of module. So Kiran, these questions are not in module. These are outside the module. So you will have to listen to me. Okay. So USA clearly, they have told that you have to adjust your cash flows. But for Nigeria, they have told us you have to adjust your discount rate. So it is clear. Let's come to solution. For USA, certainty equivalent. Approach can be applied. In certainty equivalent approach, we always used to take the risk-free discount rate, correct? Because this is what we have clearly mentioned while we were studying. So here, cash flows, present value at the rate 3%, because we have seen 3% is the risk-free rate. And then what is the present value? Year 1, cash flows are how much? 10,000 USD multiplied by 75%, which brings it as 7,500. 0.97 percentage. Wait, it should be 0.971. Okay, the present value factor, and hence the present value amount itself will become 7282.50. Yes, Darshan, you are right. So 0.75 is the certainty equivalent coefficient. Okay. The second year, cash flows are 12,000 multiplied by 75%, which is equal to 9,000 USD. The present value factor will become 0.942 and hence the amount will be 8478. I'm just rounding it off. Then the third year is 12,500 multiplied by 75%, which is 9375, 0.915, and here it will be 8578.12. Last year, fourth year, 13,000 multiplied by 75%, which brings 9750, 0.888, 8658, and hence the total is 32 996.62. So in US dollar terms, the present value of cash inflows is this much, and the USD investment, sorry, the US investment in rupees will give 2639,729.60. So this is the amount in INR, and how we have arrived at 32,996.62 multiplied by INR rate. What is the INR rate given in the question? 80 rupees. Okay. Yes, Darshan, you are right. If the cash flows are uniform, you can use annuity factor also. Okay, but the chances are very less that in some of the questions the cash flows will be uniform. Okay. Now let's come to the, we have solved for the USA investment. And ultimately, why is there a need to convert everything in INR? Because it's an Indian company. Ultimately, Indian company will evaluate the decision in INR only, right? Because Nigeria Naira is not comparable with USD. So that's why they will compare the numbers in INR. Nigeria investment proposal can be evaluated using risk adjusted discount rate. So RADR Nigeria investment will be how much? 3% from US investment plus over and above 4%, which is the country risk premium, plus 3% for the internal risk assessment. Correct? So RADR becomes 10%. Okay, students, RADR becomes 10%. Now it's just a matter of discounting the Nigeria Naira amount in the 10% here. 1, 2, 3, and 4. Nigeria Naira amounts. 40 lakh Naira is the first year. 53 lakh Naira is the second year. 55 lakh Naira is the third year. And then 65 lakh Naira is the last year. Then present value factor at the rate of 10%, 0.909, 0.826, 0.751, 0.683. And the present value amount will be 36,000, 43, 77,800, 41, 30,500, 44, 39, 500. The total comes out as 1 crore 65 lakhs 83,800 Naira. This is again Naira. So don't remember, this is Naira. Okay, so Darshan is asking, how is that 4% also part of the risk-free rate? Okay, I will explain that. First, let us complete this, then I will try to explain. So, Nigeria Naira amount will be 1 crore 65 lakh 83,800, and Nigeria investment in rupee terms will be 165, 83, 800 divided by 5.5. Hence, it is equal to 30, 15 to 36.36. Correct? Now, Nigeria investment is giving 30,15,000 INR. US investment is giving 26,39,000 rupees. So definitely Nigeria investment is better. Since Nigeria investment is giving higher present value of cash inflows, because the question has said cash outflow is same, right? So we are saying basis the higher present value of cash inflows, hence it should be selected. Simple. Okay, so now the question, which is very interesting question from Darshan, is that why 4% is part of the risk-free rate? Now let me explain you why. So there is a term called interest rate parity. Let me open a new sheet and try to explain. See here, USA is there. This is India. And let's say this is Nigeria. Have you ever wondered why the interest rates in USA are far lesser than what is appearing in India and Nigeria? What are, let's say, general interest rates in India? 7 to 10%. USA is 1 to 3%. And now only it has increased to 3 or 4%. Earlier it used to be around 1.5% only per annum. Similarly, let's say Nigeria would be another 15 to 20%. Correct. Why this difference is because of the and this I'm talking about the return on the government bond, pure return on the government bond, which are the risk-free returns. Yes, Bhumika, I'm trying to explain that only. 4% is not risk premium. I'm trying to explain why we have considered that 4% as a part of risk-free rate. Okay, please hear me out. So I am taking this case as a base here that USA mostly the returns are in the range of 1 to 3%. Nigeria, it is higher. India is, let's say, 7 to 10% that we all know. And this is what I'm saying, the return on the government bonds, which is the risk-free rate. Now, the estimates from IMF, I mean, if you see the question, and this also actually happens in real life also. So there is a saying that US dollar is depreciating by 1 to 3%, while INR is depreciating by 10%. That is why the exchange rate of INR versus USD, every year you see USD keeps on getting stronger because USD is getting depreciated at a lower rate. That is another angle to see it. Now, the third angle to see it is there is a term called interest rate parity. Now, whatever borrowings or lendings happens in US or let's say in US dollar, we will always say that the rate of return on investment or borrowing rate of interest on borrowing would be limited to 1.1 to 3%, correct? But if it happens in INR, the moment you borrow in India in INR, you will be applied the interest rate of 7 to 10%. That is because of the interest rate parity. So interest rate parity is actually related to the exchange rate that keeps on coming. And hence, this difference always appears. And similarly, this difference with Nigeria, the same logic you can build for Nigeria also, it will also appear. So if you read out this line, this is only a country risk. So if you see this 4% is only a country risk premium, okay, which is to invest in Nigeria over and above USA, because the investor will prefer, if I invest in USA, I'm getting 3%. If I invest in Nigeria on a risk-free basis, I should get 7%, because the risk of investing in that country is 4%, because the moment you will pull out your money back, the exchange rate would have declined, like this INR to USD, Naira to USD will get declined, and hence you will lose at least 4% of your investment. That is why the total return is 7%. Okay. I've tried to explain basis, whatever is given in the question, but this 4% is actually not the risk premium. It is the extra amount expected out of the investment in that country, which is for this country, this amount is actually risk-free itself. This 15 to 20, or in our case, that was 7% in our question. Okay, students? Now let's come to question number 2. Calculate cash flows of project A for all the possible events. Now they have given possible events, and they have also given us the probability, but they're asking us to calculate the cash flows. So this is also unique question, correct? Because we have to calculate the cash flows. Now, one of the estimation certainty for the above cash flows from management is that the estimates for possible events increase by 2,000 rupees progressively as we move from possible event A to B, B to C, and so on. So that means if let's say, yes, Bhumika, 4% is the specific risk. It is not the risk of cash flows. Maybe I can put it like this. It is not the risk of cash flows. It is the risk of investing in that country. Okay. If had it been the risk of cash flows, it is a very much RADR adjustment, but it is not risk of cash flows, because the risk of cash flows is the 3% that is given by the internal department. Correct. Now let's come back. So coefficient of variation for the above is given as this, and standard deviation is given as this. So they have also given us the coefficient of variation and standard deviation. So first of all, let's try to use whatever information is given in the question. So coefficient of variation is equal to standard deviation divided by mean. So this is what we have studied in our previous session. 0.1565 is given. Standard deviation is given as 210.90, and hence we will be able to calculate the mean from here, which is easier one. So the expected cash flow, which is again mean, is 2190.90 divided by 0.1565. So mean comes as 14,000. So this is step 1. Whatever it is possible from our side to calculate, we have calculated. Then it is also given in the question that progressively the cash flows keeps on increasing by 2,000 rupees. So let cash flow for possible event A be X. Now, can we put it like this? Possible event A, B, C, D, and E. Cash flows X, X plus 2,000, correct? Then third will be X plus 2,000 plus 2,000. Then D will be X plus 2,000 plus 2,000 plus 2,000. And lastly, it will be x plus 2000 plus 2000 plus 2000 and another plus 2000. Probability we know 0.10, 0.20, 0.40, 0.20, and again lastly 0.10. Yes, Bhumika, you were right. 14,000. That was the answer. So if we multiply in the below table, I'm actually multiplying the probability. So the expected cash flow will be A, B, C, D, and lastly E. So here I'm multiplying X and 0.10, correct? In the expected cash flow column. So 0.10x, then comes 0.20x plus 400, 0.40x plus 1600, then 0.20x plus 1200, then lastly 0.10x plus 800, and hence the total will be x plus 4000. I hope this is clear. So in this, I've just multiplied with the respective probabilities, cash flow into probability. I'm just putting here cash flow multiplied by probability. Okay. For all the respective possible events, and hence taking a total here. Then x plus 4000 is equal to 14,000. That we have already calculated. X is equal to 10,000, and hence the possible event wise cash flows are as follows: A, B, C, D, and E. Amounts 10,000, 12,000, 14,000, 16,000, and 18,000. So increasing by 2,000 rupees. Okay, Darshan, I will try. Let me speak on this part. If it is possible to upload, definitely we will upload it. Okay. So let me pause for a moment so that all of you can also write it down. I will show one by one. So I hope this was the first table which is clear. Then this is the multiplication. Then lastly, the solving part of X and putting the numbers. Okay, now let's come to next question. HM Limited is listed on Bombay Stock Exchange, which is currently being evaluated by Mr. A on certain parameters. Mr. A collated the following information. The company generally gives a quarterly interim dividend of 2.5 per share. Sorry, the company generally gives a quarterly interim dividend full stop. 2.5 per share is the last dividend declared. Okay. So the last dividend declared is 2.5. Company sales are growing by 20% on 5-year CAGR basis. So for the last 5 years, on a average, on a constant annual growth rate basis, the sales are growing by 20%. However, company expects following retention amounts against probabilities mentioned as contention is dependent upon cash requirements for the company. So the rate of return is 10% generated by the company. That is also they are giving. So the R is actually 10%. So situation A, B, C, they have given probabilities for the retention ratio. There are different retention ratios possible, and hence they have given the probabilities of the same. Now the current risk-free rate is 3.75% with a beta of 1.2, companies having a risk premium of 4.25%. So here your CAPM knowledge is used, right? 3.75, beta 1.2, and a risk premium of 4.25. But there is a catch in this statement. I will tell you. You are required to help Mr. A in calculating the current market price using the Gordon's formula. So what is Gordon's formula, first of all, students? Market price using Gordon's formula. P0 is equal to D0, 1 plus growth, KE minus DR. Correct? Now, first of all, D0. So we have said that 2.5 is the last per share dividends given, but it is an interim dividend. So for the full year dividend, it will be 10 per share, correct? So this is one of the catch, because 2.5, it is the last paid dividend, and it is mentioned in the question that they pay interim dividend on a quarterly basis. That is also they have mentioned, right? So for 1 quarter, 2.5, 4 quarters, 10. Annual dividend is 10. Then growth is equal to B into R. This is what we also know. Calculation of expected retention ratio. Because there is no one retention ratio, there are different probabilities, and hence we can use them to find out the expected one. Situation A, B, C. Probability. Sorry, 30%, 40%, and another 30%. Retention ratio. This is also given in the question. 50, 60, 50. Expected retention ratio. Sorry, we can just multiply the probabilities with the retention. So 30% multiplied by 50%, 0.15. I'm sorry. Then 0.24. Then 0.15. The total is 0.54. So the growth will be 0.54 multiplied by 10%. B into R. R was already given in the question as 10%, correct? So this comes as 5.4%. Now we have everything that we need for the question. We can just simply put P0 is equal to dividend of 10, 1 plus 5.4% divided by 8% minus 5.4%. This 8% is also given in the question. No, sorry, 8%. Now let me explain how we have calculated. KE is equal to risk-free rate of return, beta, multiplied by return in the market minus risk-free rate of return. Correct? Now the catch here is they have given us beta, but they have also given us this entire number as 4.25. So there is no need to apply beta, correct? Because they have directly given us the risk premium associated with the company. They have not given us the market risk premium. If they've given us the market risk premium, then we would have multiplied it with beta. Okay, students? So such a good question these are. I mean, these are revising all your different concepts. K is equal to 8%. This is what we have put here. And hence, the value is 10.54 divided by 2.6 percentage, which is 405.38. So the price is actually 405.38. This is working note. Okay, students. So Darshan is saying this is combo of both the chapters. Yes, you can say, because it has some probabilities, it has some CAPM, and it has some dividend related discussion. Okay, so Krishna is asking, what is this KE formula? So Krishna, this is from the CAPM, capital asset pricing model. I hope all of you would have studied this, right? In your capital asset pricing model, CAPM, the cost of equity is equal to risk-free rate plus beta. We put beta like this, multiplied by RM minus RF. So this is the market premium. And the moment you multiply it with beta, it becomes the company's premium. Already in the question, company's premium was given, and hence we have used that. Okay. I hope this is clear, students. Now coming to the last question. Okay, let me just pause for few moments so that all of you can actually note this down. So Darshan is saying yes, CAPM is covered in the cost of capital. Okay, Darshan, thank you. So from there, you can put a inference here that has been applied. The above part of the question was this. Perfect. Thank you, Bhumika. Thank you, Krishna. Thank you, Darshan. Okay, now let's move further. Last question is this one. DG Limited is expected to pay 200 rupees per share as dividend in next year, which is fine. However, it has decided to close off and sell one of the business units because of certain contractual and legal constraints. So the company would be undergoing through some restructuring. Under that, it would have planned to close and sell one of the business unit, not the entire company. The above decision would lead to a declining growth rate of 4%. The moment you are actually selling off one of the business unit, it might turn the entire company into a declining growth rate. So the growth rate will keep on declining. The required rate of return is 10% on the stock price of DG Limited. Okay. So KE is given as 10. Growth is equal to -4. So remember in the previous session, in the previous session itself, we discussed growth and degrowth, whereby I had given one example, 100 become 150, 150 became 220, and 220 again went down to 100. So I said growth can be positive and there can be degrowth also. So this is the question on degrowth. Compute the value per share of DG Limited as per Gordon's growth models. Question is very simple, but it is just to tell you that growth can be negative also. So Gordon's growth model is equal to dividend 1 divided by KE minus DR. Or let's say I can put growth here because it's given as growth. So D1 divided by KE minus growth. Value per share will be 200. So 200 is given as next year. So we are taking as D1 divided by KE is 10% minus 4%. Correct? Minus 4% is the growth. So that means 200 divided by 14%. So the value per share comes out as 1428.57 per share. That's all. This was relatively an easier question. I hope this is clear, students. Shall we move on? No, so Darshan is asking, can you clarify that 10% is R or KE? No, 10% is KE because it is mentioned that the required rate of return. That means the expected rate of return is actually 10%. So that means KE is 10%. Okay. Yes, Bhumika, you're right. 1428.57. Perfect. So I think we are done with all the questions that we had. Now let's spend some time in making the revision part. Let's start with the dividend part again. If there are any balance queries, please do let me know. I think day before yesterday, there was one query on risk analysis. I will take it now. If the student can again post it, I don't remember the query. Please post that query on the risk analysis and capital budgeting again. Okay. And let's do the revision part. So dividend decisions, we started saying that there are different kinds of decisions that we are actually learning in the entire financial management. One is on the financing decision bit, investing decision, which is the capex one. Financing decision would essentially mean from where are you going to source your funding requirements. Then dividend decisions is how much to pay and how much not to pay. Then we also understood that this decision is not a very easy decision, because the problems are, if there is any abnormal gain or loss, then how are we going to deal with it? Ultimately, the objective of dividend should be to increase the shareholders' value. That is the share price. So it should happen in such a way that the wealth of the shareholder should not be impacted. We also studied that what are the different modes of settling a dividend. One is definitely a cash outflow, that is a cash going out from the company to the shareholder. Second is in the form of the bonus share. And third one, we also studied a new thing which is called as shares buyback. Okay. Because while you are doing a shares buyback at higher than what is there in the market, that means you are actually giving some extra return to the shareholder, which is essentially dividend. Then we also studied that what is the significance of dividend policy. So we said that there are two parts to it. One is long-term financing decision. In this, we clearly made out that if your return on equity let's say so I should put here expected return. Your expected return on equity is KE, which was 18%, and investment opportunity was fetching you 20%. So we said that better to keep the funds with the company itself. Then second principle we studied on the wealth maximization bit, which we said that immediate dividend would lead to higher MPS. That is just a theory. Then we studied about the growth part, which we discussed just now. We said growth is equal to B into R. So whatever you retain, on that, whatever you earn, that is your incremental to what you will get in future. That is what growth is. Retention ratio, dividend payout ratio, these are things we discussed. Then came the main part of the dividend decision, which is irrelevance theory and relevance theory. So the irrelevance theories were of the views that whether you pay dividend, whether you don't pay dividend, the value of the company will remain same, whether at the end of the period and whether at the beginning of the period. So it was a step-by-step approach in which we said that if you pay dividend, it will form part of cash in hand with the shareholder. The overall amount will not change. And if you don't pay dividend, the overall amount will also be the same. We also studied about cum dividend price and ex dividend price, because the moment you pay dividend, that much amount itself gets reduced from the share price. Correct. Then we did some examples here to understand it better. But in a nutshell, to summarize the entire approach, we said that there are 4 steps. One is to identify the future price, that is P1. Second is to identify the funds requirement, because your funds requirement is not only dependent upon whether you are going to pay dividend or not, but it is also dependent on the investments and the earnings that you are going to make. And hence, we said that those are also taken into account while calculating your funds requirement. Then the third step was to calculate the number of equity shares based on those funds requirement and basis the share price calculated in step 1. The last part would be to calculate the value of the firm. And today we learned a tweaking here in which the last question we discussed, it was calculating the value of the firm at the end of the period. And this formula actually gives you the value of the firm at the beginning of the period. I hope this was clear. Okay, students. Then we studied around some questions. Then we have studied about the relevance theory, Walter's model. Walter's model, we studied that price, if you multiply KE, we have a dividend. So dividend, so this was the formula that we studied, right? So that is the current dividend as well as the expected growth on which you are going to get a return. Then we also studied that what is the relationship between dividend and MPS. This was very, very important, because this will form basis of your optimal dividend policy also, right? If you are into a growth firm, better to pay zero dividend, and if you pay dividend, then your MPS will go down. This we have also proved in today's question. If it is constant, then there is no correlation. Any ratio will become your optimum there. If it is a declining case where R is lesser than the KE, that means you should pay dividend, and hence higher dividend means higher MPS. So it was positively related. Okay. Then second part of the relevance theory was Gordon's model. I have to, okay, there is one question from Darshan. So the question is stock split also form of a dividend? If you say, see, stock split, essentially what is happening is your share capital itself is getting divided into smaller portions. Correct. Now, in a way, it is form of a dividend. Why? Because you will end up selling that and realizing some cash. That's all. Correct. So let's say earlier you have one share of 500 each. Now you have 5 share of 100 each. You can sell one share and you can realize that 100 rupees. And ultimately you will have 400 as your balance holding, 100 as your cash, and your overall wealth will be 500. So yes, you can say that it is form of a dividend because it is helping you to reaping out the benefit there. Okay, then this is the Gordon's model where we said this is the earnings based model, earnings and adjusted for the retention ratio, which is the dividend divided by KE minus DR. Then we also studied the modified version of this formula, which was the so the dividend growth model, which is dividend at 0, 1 plus growth divided by KE minus G. Then we said that there are 3 types of growth: zero growth, constant growth, variable growth. Zero growth, this formula holds true. Constant growth, Gordon's formula holds true. And variable growth, we said that you will have to take a present value of all the dividend that are expected to be paid in future. Then we kept on coming down. We then came to the traditional theories, Graham and Dodd model, which includes the application of a multiplier, and which said that dividend is 1 time the weight of 3 times, 1/3 of earnings, correct? Then we also studied about the Linter's model. Linter's model is again based on one of the adjustment factors, and it said what is the incremental amount that we are going to pay as dividend that needs to be adjusted for the incremental adjustment factor. Stock splits we discussed. Then we discussed some of the key concepts. What is PE and KE? How are they related? P ratio and K ratio. I think that's all. In terms of the conceptual understanding, that's all we have studied, and we have again done a lot of questions to understand the applicability of all these concepts. So this is it from the revision part of dividends. I think apart from revision, we have covered a lot of things today. Okay, so that's it. And let's go to the risk analysis and capital budgeting. 17th May we took. Okay, Darshan, thank you. So, under risk analysis and capital budgeting, we started saying that capital budgeting is actually the main core capital budgeting you have already studied. It involves the study of cash inflows and cash outflows. But practically, we will have to assume that there are certain estimation issues related to the both cash inflows and outflows, and hence there is a risk. So that risk needs to be sorted out. How? By using some probability techniques. And we also said that there are 3 kinds of situations: certainty, risk, and uncertainty. Certainty, which is 100% bound to happen, nothing is needed. Then risk and uncertainty. Risk we evaluated further, and we said that what statements makes more sense if the average one or average along with the plus minus the range, correct? because ultimately the expected outcome is 3400, but it can go down to 2900 and go up to 3900. Then we studied about some of the statistical terms. Average is mean, risk is standard deviation or variance, and why we also studied the deviation of all possible outcomes from the best possible outcome, which is the mean. Then we studied what are the techniques. Probability, as we all know, it's a chance of an event occurring. It can be from 0 to 1. And we also studied that how to calculate the expected net cash flows and expected net present values through the help of some of the questions. So questions are actually self-explanatory. These are just formula-based questions. Then we studied that risk can be variance or standard deviation. Standard deviation is actually a square root of variance, and variance is the square of standard deviation. And we also studied that while we open up the standard deviation, plus minus comes, and that forms part of our basis of plus and minus range. We also studied that while evaluating two projects, project A and project B, better to compare it based on the coefficient of variation rather than mean and standard deviation. If you standalone compare it basis the standard deviation or standalone compare it basis the mean, it will throw a wrong picture. Then we studied about the risk adjusted discount rate, on which we have done one question today itself. So we said that interest actually comprises of two parts. One is time value of money and second is risk. Okay. And risk of non-payment and time value of money, because the money keeps on depreciating. So what we said is, while we use RADR, it has to be increased by the relevant risk profile of those cash flows. Okay. That we have also studied today in the Nigeria case, because Nigeria's cash flows were highly risky, hence we have taken a 3% additional adjustment. Then certainty equivalent approach, we studied that instead of making the discount rate adjusted for risk, let's make risky cash flows adjusted for risk. So we studied that there is something called as guaranteed cash flow and there is a risky cash flow, and adjusting them makes it easier. So what we said is, in RADR, increasing the discount rate. In certainty equivalent approach, we are reducing the cash flows so as to ultimately reduce the NPV that we have. Then we studied about these good questions that we had. Then I think the last two part was on the other techniques. One is on the sensitivity analysis. In sensitivity analysis, we have actually studied that for all the inputs that are going into the capital budgeting model and hence which is throwing as NPV as an output, which input is most sensitive. So what we will do in sensitivity analysis, one input we will change at a time and rest other inputs we will keep it as constant. So there will be a base case. Against that base case, there will be different actually sensitivities that would be required. Okay. Then we also studied about the scenario analysis. Under scenario analysis, we said that all the inputs are going to change to form a different scenario altogether. It's not that one is changing at a time. They said that all are changing at one go. Okay. So I think this was it from the risk analysis and capital budgeting. I think there is one question from Bhumika. Sir, if in scenario analysis question, depreciation given on fixed assets. So, sir, what would be the treatment of depreciation? So, Bhumika, actually, if you see the depreciation part is a non-cash item, but you save tax on that. So, I think in your capital budgeting questions, you would have already taken the tax savings on the depreciation, but you would have not taken the depreciation itself for the purpose of your cash inflows. Okay. So, the treatment will again remain the same. Whatever you have studied in your capital budgeting, in scenario analysis also the depreciation part will remain same. Okay, so there is no change out there. Okay, Bhumika? So students, that's all from my end. Are there any other further questions that are there? So please do post it. Bhumika, okay. Darshan, thank you. Okay. Anything which you feel you want to discuss, or we can wrap it up. I hope you enjoyed the session, and I wish all the very best to all of you for your preparations and coming out, clear chartered accountants in the future. So all the best for your preparations, and please do revise well. Okay. I'll wait for 1 more minute if there are some things that are posted on the query handle. Then we will finish. Krishna is saying thank you. Thank you, Krishna. So these two topics are very relevant from your, practical life also, because dividends, as we know, is very much relevant. And this risk analysis and capital budgeting is used by a lot of companies to evaluate that whether they want to do any sort of investments or not, because every investment would have the risks involved in it. Okay, so thank you everyone then. Have a good revisionary, or let's say have a good time to do all the revisions that we have discussed. Okay, so all the very best. Thank you.